So, if we are given a table like this that takes into consideration the cumulative probability of default of a counterparty, understanding what is the probability of defaulting by the end of a given year is not a problem. We just go to the corresponding combination of rating and column. So for a triple C bond, that would be 20 for by the end of the second year, it is 26.92%, which is it's a quite big value. Obviously, the first column corresponds exactly with the PD that you can extrapolate from the transition matrix. The second question is a little bit more interesting because the second question is, given that I have this table, what's the probability that the same bond, so we are still considering the triple C bond, what's the probability that that bond defaults during the second year? Now, in that situation, it's different because what we are asking is not to observe the default between today, assuming that today is day 0, and 2 years from now, but we want to know what happens from 1 year from now on until the end of the second year, so exactly during the second year. In that case, the probability can be computed in the following way. We take the probability of defaulting by the end of the second year and we subtract the probability of defaulting by the end of the first year. So what we get is the so-called unconditional probability of default. So the unconditional probability of default tells me what is the probability of defaulting during the second year in this specific example. But there is also a third type of probability that is extremely relevant, and it's the conditional probability of default. The conditional probability of default is the following. What is the probability that a triple C bond will default during the second year, given that it does not default during the first year? Now, every time you observe the word given or the composition given that, you are essentially conditioning, you are putting a condition on the type of probability that you are computing. While in the previous case it was unconditional because there was no condition of this type. Now, here what we are asking, it might seem the same thing, but actually there is a subtle difference. In the previous example, I was telling you and I was asking you what is the probability of defaulting during the second year. And this probability is the probability that I can extrapolate from my table at time 0 using the information that I had there. When I ask you what is the conditional probability, so the probability of defaulting during the second year, given that I have not defaulted during the first one, I'm slightly changing my point of view. It's like I'm moving from time 0, where I'm now, to time 1. And say, I'm imagining that I'm in time 1, and now I want a 1-year projection from time 1 to time 2. Okay? In the conditional probability, you study what happens in time between time 1 and time 2 now. With the conditional one, you are making a sort of assumption of shifting yourself at the end of the first year, because you are asking given that you did not default by the end of the first year. If it were, what is the probability of defaulting during the 5th year, given that you have not defaulted by the end of the 3rd year, you're essentially shifting yourself to the 3rd year at the end of the 3rd year and making a 2-year estimation of the PD. So if you do that, what we have to compute is slightly different. Because what we have to compute is, first, the probability of not defaulting by the end of the first year. And that quantity is simple to obtain. Why? Because we have the probability of defaulting by the end of the first year, which is the first element, 19.79. The probability of not defaulting will be what remains to 100%, or in decimals, what remains to 1. So for us, it would be 80.21%. That's the probability of not defaulting during the first year. Then, what is the probability of defaulting during the second year? It's exactly the unconditional probability we have computed before. So the difference between 26.92 and 19.79. Once I have these two numbers, I take the ratio. I take the ratio of the previous probability, which is 7.13, and the first one, which is 0.8, and the quantity I get is 8.89. You see, these two quantities are different because it's different the type of question I'm asking myself. In the first case, I repeat, in the unconditional case, you are saying, looking at the data I have, given the information I have, what I do, I try to just compute now, without any specific condition, what would be the probability of default in the second year. In the second situation, is like I'm making the mental experiment of being in 1 year from now and making a 1 year projection towards the end of the second year. Okay? That's why you get the different. Fine. This is ratings. So the point of ratings is that we have some sort of classification that can be different, but they all agree on the fact that once I have a rating, I have, for example, the probability of moving from one rating class to the other, and I know the PD. Given that information, so for example, in the standardized approach, you remember we had that table in which we had govies in the different classes. How do I know that? I know that if I buy a bond from country X, the rating is epsilon. I look at the epsilon, I know what is the probability of default, I know what is the risk weight I have to apply to compute my risk-weighted assets. As simple as that. If I don't have access to the rating of a counterparty, I have to estimate the rating somehow myself, using internal ratings, as we will see, or using specific models for the computation of the PD, such that that information can be input into my formulas coming from the Basel framework, and I can get the capital requirements. This is what we will do in a minute by considering a model for the PD given by this guy here, which is Robert Merton. Okay, imagine that we don't have the credit rating available for a counterparty, and we want to estimate, because we need that for our formulas, the PD, the probability of default of the counterparty. Now, there are different methods that can be used. Obviously, we don't have the time to consider all methods. In the choice of the different methods, I think that knowing this model is important. Why? Because even if the model we will consider is what we call an academic model, it's a model that relies on very strong assumptions, that is hardly used in practice due to the fact that the assumptions are quite strong and not at all plausible for the everyday life. This model is nevertheless the starting point of other models we will consider that are industry models, so models that are actually used. Okay, so in order to understand those models, you need this guy. Now, this model was introduced in the 1974, and this guy, Merton, received the so-called Nobel Prize for Economics together with Black and Scholes, because Merton's model is to credit risk what Black and Scholes is to asset pricing. And actually, you will see in a minute that is essentially the same model in another environment. And since they arrived to the same conclusions more or less at the same time, and at that time there was no Google, so it was not that easy to find works of your colleagues, we can assume they were independently developed. It is the basic representative model of a class of models that goes under the name of structural models of default. In the IRB class of Basel II, Basel III, you can use it if you want. Again, it's not really used, but it will fit within the IRB class, so both the FIRB and the AIRB. Now, a structural model of default is something very simple. The idea is that you have a quantity that can be the total value of a company, can be the equity ratio, can be the debt ratio. Depending on the models, this quantity can be different, but the idea is always the same. You have this quantity that moves over time, and if you want to be fancy, you say that it's a stochastic process, okay? It's something that moves over time. What is a stochastic process if you're not used to? You have a random variable. A random variable is essentially something that can have different values with different probabilities. If this random variable is observed over time, and so it's allowed to change over time, it's a stochastic process, okay? Then my colleagues in applied probability would kill me for that, but that's essentially what a stochastic process is. So you have this stochastic process moving, and what you are interested in is in the fact that this quantity touches a barrier, touches a threshold. So, for example, in a structural model of default can be that the equity ratio is your random quantity, and when the equity ratio goes below a given threshold, you have the default. Or if you have the total value of the company, when the total value of the company, as in Merton's model, touches a given threshold, so goes below this threshold, you have the default. In case of the debt ratio, could be, for example, going above a given threshold, and so on. But it is that there is a threshold mechanism. Every time you touch the threshold, you have the credit event. Credit event is the euphemism for default. Now, this model relies on a certain number of assumptions that are very important to understand how unrealistic the model is. The first is, and this is not the most unrealistic, it's just restricting the use of the model to a certain type of companies. The first assumption is that we consider a limited company. A limited company is a type of company in which, when you create the company, you are obliged to bring some capital, okay? So in order to create a limited company, you are supposed to bring some capital. But once the minimum capital has been reached, in case of a default, you as shareholder of the company, so as one of the owners of the company, you just risk to lose the amount of capital that you brought for the creation of the company. Okay? So if in order to create a company you need 20,000 euros, and me and a friend of mine put 10,000 euros each in the company, in case of a default, essentially our liability to the company is 10,000 euros each. Okay? This is different from other type of companies like personal companies, in which, for example, and these are mainly the companies that you can have for the small shops and these kind of things, in which if there is a default, first you lose the capital that you have in the company, but if that capital is not enough, they can come, knock at your door, take your house, take your car, take your boyfriend, take your girlfriend, maybe you're happy, you don't know, but they take something from you apart from the capital that you brought for the creation of the company. Okay? It's a substantial difference. And the fact that this is limited, that is to say that if I'm the shareholder, I'm just responsible for the capital I put at time zero in the company, you will see is a fundamental assumption for us. Then our company can, as all companies, finance itself using equity and debt. If you want to be fancier at a higher level, you would say that these companies satisfy the Modigliani-Miller theorem, but we don't care. So we have that the company can finance itself with equity and debt, and there is a specific representation for debt. Again, another of the weaknesses of the model. Debt is represented by one single debt obligation that for us is nothing more than a zero coupon bond. It's a zero coupon bond with a face value capital B and a maturity capital T. Capital T can be 1 year, 2 years, 3 years, 5 years. So how does it work? It works like that. Imagine that you are the management of the company, a limited company, and you have your production plans. Okay? In order to do what you want to do with your company, you need 100 million euros. Okay? but you don't have 100 million euros. Say that with your resources you have 70 million euros. You still need 30 million euros. What can you do? You can issue a bond with a face value B of 30 million euros and ask that money to the market. Obviously, in doing that, you are taking the obligation that you will pay back at maturity with the interest and so on. So that is represented by this single zero coupon bond. It means that between the time in which you issue the bond and the time in which you repay the bond, there is no payment. Okay? So the debt holders will not get anything from you until maturity. With ST, we denote the value of equity, and with BT, we denote the value of debt at time t, and t is between 0 and capital T. So obviously, there is a face value for the debt obligation, but this is at maturity. At time t between 0 and t, it's a different value because of the discount and because of the randomness of the phenomenon. We assume that there is no friction on the market, so there are no taxation, there is no tax, there is no transaction cost. As usual, the standard assumptions about markets that are almost perfect. But if this is the case, the value of the company, VT, the quantity that is interesting for us, just depends on the sum of equity and debt. Okay? As simple as that. Equity, you know it, because it's the equity of your company that you will model in some way. Debt, you know it, because you issued the bond, so you know capital B, and then you can derive BT. And by summing ST and BT, you have at any time T, from 0 up to maturity, the value of the company, the total assets of the company. Now, another fundamental assumption, and this is already something that in reality does not hold, is the fact that if I finance myself by issuing the bond, until I have not repaid that bond, I cannot issue new bonds. And I cannot go and knock at a bank asking for a mortgage. My only source of financing is the bond, apart from capital, own capital, is the bond. And until I have not repaid the bond, so until capital T, I cannot issue new debt. What I define a default is the following. If at maturity in capital T, I'm not able to fully repay debt, I default. It is sufficient that I'm not able to pay €1 of the 30 million, it's a default. Okay? So I have to be fully able to repay debt. In this model, and this is a strong limitation of the model, that can only happen at maturity, so in capital T. It means that only the evaluations about the default of my company are made in capital T. Why? Because it's in capital T that I can verify that I'm able to repay or not my debts, obligations. Now, there are two possible scenarios in this model you can imagine. One is I'm able to repay debt. One is I'm not able to repay debt. In the first case, what we have is that the value of the assets of the company, V capital T, because we are at maturity at the moment, is larger than the face value of debt, capital B. Now, if this is the case, everyone is happy because the company is safe, is able to repay debt, and maybe issue new debt for new necessities, but at time capital T is able to repay the old debt. And what will we have? The debt holders will receive the face value of debt. And let's assume that B also includes the small interest and everything, okay? Otherwise, you should also input that part, but it's minor things. So we have that the debt holders take what is theirs, so the face value of debt, and what is the equity value of the company. It will be the value of the company at time capital T minus what the company pays back. So S capital T is equal to BT minus B. Opposite situation. In the opposite situation, the company has a total asset value which is not enough to repay the face value of debt. So VT is smaller than capital B. You see here that I write smaller than equal to. For a moment, allow me to forget the equal to. So I'm saying that V capital T is smaller than B. What happens there? Obviously, if you are debt holders, you will get the value V capital T, which is not exactly capital B, it is smaller. So the company defaults, because that's our definition of default, not being able to fully repay debt. Debt holders get the value of the company, and now here we have the importance of the limited liability assumptions, the fact that we are playing with a limited company. Why? Because if you are the shareholder, so if you own the equity of a limited company, in a situation like that, you essentially have the incentive not to bring new capital to the company. Why? Because as soon as you bring new capital to the company, that capital will go to the debt holders, because you have to repay the amount of debt that you have not repaid. Since it's a limited company, what you can do, you say, okay, I'm just responsible for the capital I brought to the company when I created the company. Now it's yours. It's your problem. So the company is yours. You get B capital T. It's everything yours, and I'm not bringing new capital. If, on the contrary, you have the risk that they come and take your house, you have the incentive maybe of bringing new capital. Okay? This is not the case here. Again, notice that we are in a totally idealized situations. We are not speaking about people losing jobs, unions protesting. There is nothing like that, which is extremely important in real life, but here we don't care. Okay, so you see why it's not really plausible. So what you have, B capital T is equal to the value of the company, V capital T, and ST is equal to 0, because the shareholders just give everything back to the debt holders. This is default. Now, I told you that I was considering the situation with a smaller than, the strict smaller than. Why do I put the equal sign? Now, formally, you could put the equal sign on both scenarios, because it's true that if default is defined as the fact that I'm not able to fully repay debt, and V capital T is equal to capital B, I'm in principle able to repay debt. But no company can survive with an equity equal to 0, okay, legally speaking. So that's why we can safely put the equal sign to the second scenario. So under the first scenario, the company is safe. Under the second scenario, the company defaults. Notice that here, because of the fact that the shareholders give the company to the debt holders, we are in a specific situation in which default corresponds to the liquidation of the company. In real life, this is typically not the case. Default is a technical condition. It means that you are not able to fulfill a debt obligation, and obviously it's a problem, but then there are procedures, different procedures, for which, for example, you can bring new capital, or the state intervenes in order to try to save the company and to safeguard jobs and these kind of things. Liquidation means that you disappear from the market. You completely disappear from the market. In Merton's model, default equal to liquidation. Okay? In reality, this is not the case. Before liquidation, you always try to save a company because of the different interests related to the company. Now, if you want to summarize the two scenarios, what you see is that ST under the first scenario is equal to VT minus B, and under the second scenario is equal to 0. BT is equal to B under the first scenario and is equal to V capital T under the second scenario. If you put these two things together, you have that S capital T is the maximum between VT minus B and 0, and BT can be written as B minus the maximum between B minus VT and 0. Now, since you are trained and experts in these kind of things, you will recognize that the value of equity is nothing more than the payoff of a European call on VT. So it's a European call on an asset, on an underlying asset, which is what? The value of the company. And the strike price is what? The face value of liabilities. For what concerns, on the contrary, the value of debt, that is the face value of liabilities, B, capital B, sorry, minus the payoff of a European put on the same underlying asset and the same strike price. Now, if this is the case, you understand why there is this very important connection between Black-Scholes and Merton. Essentially, they are playing with the same object. The only difference is that Black-Scholes, they play with the prices of assets. Here we have the total value of the object of the company, but still the objects are the same. It's a European call, a European put. Okay, they are the same type of objects, so the same machinery will be used to solve the problem. Now, for us, you can do that, but it's not very important to try to price equity and debt. It is interesting, but it is not particularly relevant from a risk management point of view. What is more interesting for us is to try to understand what is the probability of default of the company. Now, for us, default is the situation in which V capital T is smaller than equal to capital B, because this is the way in which we have defined default. Now, what can we do? We can make some assumptions about the stochastic process that is behind V capital T. And without being pedantic, you can assume, as in Black-Scholes, that that process will be what? A geometric Brownian motion. If this is the case, if you assume that V capital T follows a geometric Brownian motion, what you know that the value of the company is essentially log-normally distributed, and from that information you can easily extrapolate the probability of default. For us, the probability of default is the probability that V capital T is smaller than or equal to capital B, and it's that. It's the CDF of a standard normal computed in that object, which is the logarithm of B over V0 minus R minus sigma square V, which is the volatility of asset, divided by 2 times T, divided again the volatility square root of T. Now, here there will be issues about, for example, how to estimate the volatility of an asset, or issues about should we really use R, that is to say the risk-free rate, or should we use the drift, the real rate of the geometric Brownian motion. These are technicalities that we will not cover, but we can say something important just looking at that formula. By taking that formula for granted, there is already something very important that we can say. Now, imagine, just consider, for example, B over V0, which is the argument of the logarithm. What can be B over V0? So V0 is the value of the company at time 0, okay? Which is the sum of equity and debt at time 0. B is the face value of debt, the liability threshold of the model. If I take B over V0, this is, if you want, a measure of leverage. It's a debt ratio. It's debt, capital B, over the total value of the company. And it's easy to see if the leverage goes up, if the debt ratio goes up, the probability of default goes up. Why? Because graphically speaking, that probability of default is this. I have a normal distribution. Why normal? Because I know that Vt is log normal. But then it means that the log of Vt is normal, or phi, if you want, is normal. And when I write, because of the property of the logarithm, if I write this guy is equal to this guy. So I can immediately play with the normal distribution. When I do that, what I'm doing is essentially taking this value x, and x is the argument there, so it's the log minus r, blah, blah, blah. And I'm considering this probability here. Okay? Actually, it would be more on the tail here, but still, the idea is the following. So if I'm computing this guy, it's this area. Now, if the debt ratio goes up, so if B over V0 goes up because I'm asking for a higher amount of debt at time 0, what do I have? The log of that goes up. So it's like the quantity x is shifting to the right. If the quantity x is shifting to the right, the area under the curve increases. So the probability of default increases. What happens on the contrary if the time horizon increases? Again, if the time horizon increases, at the denominator we have the square root of t, at the denominator we have t, so obviously the numerator prevails. And if you increase the time horizon, you are increasing uncertainty, and it makes sense that the probability of default increases. What happens if you increase the volatility of the assets? Obviously, you do not increase the volatility of the asset, but what happens if the volatility of the asset increases? It's not something that you can choose. What happens if the volatility of the assets increase? The probability of default increases. And the volatility of the asset is, according to me, the most interesting part here. Because the volatility of the asset is a measure, if you want, of the risk, but also of the possible profitability of a company. The volatility of the asset tells me how volatile the asset of a company is. Now, imagine that you are the management of a company. If you are the management of a company, if you take very risky decisions, and I'm not speaking about investments, it's really speaking about strategic decisions about a new product, whatever you want, the riskier the decision, naturally the higher the volatility of the asset that you are generating. Because the riskier the possibility that you are taking, the larger the possible deviations that you can generate on the returns of the company. And why it is interesting? Because here you see an important conflict of interest between debt holders and shareholders. If you are a debt holder of a company like this, what do you have? What is the maximum amount of money that you can get if you are a debt holder? The face value of the bonds you invested in. Okay? For you, as a debt holder, the maximum amount of money that you can get is capital B. If you consider all the debt holders together, is capital B. So for you, what is important is that the company is able to repay that amount. And if that amount is 50, for you it is sufficient that the total asset of the company are 51 in order to repay 50. It's totally irrelevant for you that the value is 3,000. You still get 50. So you will tend to prefer a management which is conservative, that will try to make less risky strategic decisions so that the volatility is minimized and also your probability of default. As the economists say, ceteris paribus, if we keep all the other quantities fixed. So we are just modifying volatility. If you are a shareholder, on the contrary, you are totally in the opposite direction, because for you, there is no upper limit on what you can earn. What you can earn will be the difference between the value of the company and capital B. So what you want to do is to maximize the value of the company so that you are maximizing the equity of the company. And the only amount of capital that you can lose because of the limited assumption is the capital you put in the company at time 0. Okay? So as a shareholder, for you it's nice if you want to have a management that maximizes the risk of the company because you can earn more. And if you lose, you already know what you will lose. There is no randomness in that. This is the amount you lose. That's it. So if for you it's fine to lose that amount as part of your risk appetite of investing in a risky business like a company, that's fine. So you will hope for the management to take decisions that increase the volatility of the asset. So you see that debt holders prefer a management that decreases the volatility of the asset. Shareholders prefer a management that increases the volatility of the asset. And this is to the fact that volatility is a natural measure of how erratic can be the return generated by a company. So debt holders, we prefer something smooth and steady. As shareholders will prefer to have big chances of earning money. So if you want to summarize the basic characteristics of this model, it's a model that has some pros, that is to say it's simple, but at the same time it's able to describe some interesting characteristics, like, for example, the conflict of interest between debt holders and shareholders. It is easy to deal with. We are not covering all the little problems about estimating V0, estimating the standard deviation, so the volatility. But it can be done. It's nothing particularly complicated. But it also has limitations. So default is only in capital T. We know that in reality, default can happen every time. You don't have to wait 1 year. Your company can default in a week from now. Default is equal to liquidation. It means that when the company defaults, it's also liquidated. That in reality is not true. We have the Gaussian distribution, as usual, coming on. And if you want, there is another limitation, which is not a strong limitation. That is to say that if you are a bank, if you're a financial institution, and you want to use a model like this to estimate the PD of a counterparty, and how can you do? You take all the different quantities from the balance sheet, you approximate the other, you plug in the formula, and you have the PD. If you want to do that, you can only do that with companies that are limited, that respect these requirements, and typically quantities that are traded on the market. Again, this is not the type of model that you will use to estimate the riskiness of the ice cream shop on the corner. Okay, so see you next week.